Okay, good afternoon. Thank you all for joining us. My name is Andrew Sporer. I'm the Director of Marketing and Communication here at Chmura Economics and Analytics. And I'm excited to introduce Chmura's CEO and Chief Economist, Dr. Chris Chmura, and Director of Consulting and Senior Labor Consultant, Dr. Francesco Renna, who are here to discuss the current state of the economy and the forecast for recession. Using Chmura's real-time intelligence, they will also consider current trends in remote work across the United States and how those trends may shift in the future. Before we get started, I'd like to cover just a few housekeeping items and give everyone a brief overview of our organization if you aren't already familiar. As a reminder, presentation, the slides, a recording to the webinar will be forwarded to all our registrants after the call. You can also visit our website under the Resources tab to access all our webinars there. If you have any questions, you'll notice a chat box on the right-hand side of your screen. Please use that. Drop any questions you may have in there, and we'll try and address them throughout the presentation. We will save some time at the end to try and get to all of those, so I appreciate your participation there. Before we dig in, I'd like to share just a bit more about us. Chmura provides labor market data and analysis through three main offerings: our Jobs EQ software, our consulting services, and access to data. We were founded in 1998 by Chris Chmura, who's joined us today, and we've actually just celebrated our 25th anniversary. So congratulations to Chris and all who have made that milestone possible. We have two offices, one in Cleveland, Ohio, and another in Richmond, Virginia, from where we are broadcasting today. But we do serve hundreds of clients all across the country. As a team, we care about helping our customers grow their businesses and their communities. We like to say that we share in our customers' success. So really our goal is your satisfaction and your growth. And lastly, we're driven by excellence in customer service and in data quality. Really, it's what differentiates us most. In the data that we offer, in our customer support, in the quality of our analytics and consulting services, excellence is our top priority and informs absolutely everything that we do. That commitment has translated to an over 90% annual renewal rate for Jobs EQ customers, which is testament to the ongoing partnership and communication we maintain with all of our users. These are just some of the things that we hear from our customers in those renewal conversations, so we're glad that that's not unnoticed. Speaking of our customers, the labor market data, the software, the consulting services that we offer can benefit a wide range of industries, from corporate clients who need competitive analysis and benchmarking, to our partners in economic development seeking insights on labor availability of their region, to higher education institutions who need labor market data to plan academic offerings, for those in site selection who need to compare wages and average commute time between locations, the staffing agencies and talent acquisition professionals who are looking for potential customers, wage insights, and information on who is hiring and for what roles, or for those in workforce development who want to track real-time changes in their economy and identify which occupations and skills will provide the most opportunity for their workforces. Here's just a quick snapshot of those that we've worked with, some of our customers, representatives from which you can meet at our upcoming Jobs EQ Users Conference. Have to plug the Users Conference. In January, we're all heading to Universal Orlando. The conference will be at the beautiful Lowe's Portofino Bay Hotel, pictured there. Italian-inspired for sure. You can join us for keynotes from Jobs EQ power users, breakout sessions to help you refine your Jobs EQ skills. We'll have a panel-style Q&A with our amazing customer support team. Shout out to customer service here. They have an average response time of under a minute for the Jobs EQ help chat, which is incredible. We'll also have a rare opportunity for you to get FIT certified in person. That's our Jobs EQ official training and education certification, where you'll be able to learn from other users, industry peers, as well as the Chmura professionals there assisting you. For a full agenda, registration info, anything else that you need, head to chmura.com/events. Or go ahead and scan that QR code with your digital device to head to the registration website. Just a quick note, there's just 1 week left to take advantage of our discounted room rate there. So we do hope that you'll join us for that opportunity. So without further ado, I'm going to introduce Chris and Francesco, who are going to give you a brief look at the economy as it stands with our weekly economic update before diving into some more details. Chris, go ahead.
Thank you, Andrew. Yes, as Andrew said, we put out a weekly economic update, and you're looking at it here on this slide. There are 4 pages. It's a quick read to tell you what came out last week, what's coming out next week. We highlight in the second page some of the charts and why they're important. On the third page, if the Fed has spoken, what they're saying and how that might impact interest rates. And then all the way to the right, some information on the financial markets. So again, this is complimentary. If you'd like to sign up for it, you can click on that link or go to our homepage all the way down at the bottom. So with that, let me get started. I'll first be talking about the national outlook, and clearly that will impact remote work trends. We all know that remote work is here to stay, but the economic uncertainty and the changes that are ahead of us is causing the balance of power from employee to employer to take place. Labor markets are easing. We'll show you some slides there, and the recession will change some remote work attitudes. Then Francesco will talk to you about the fate of remote work. Remote work is down, hybrid is up. Workers are back in the office, but only 2 to 3 days a week. And in part as a result of the remote work, the value of commercial buildings, office buildings, has plummeted. And Francesco will go over all those topics after we take a look at the national overview. And clearly there are signs of a slowing economy. The labor market is cooling down, but it remains rather tight. On the left-hand side, the first slide shows you total employment change. And you could see when we went into the COVID recession, a big drop off in employment, but then it rebounded very quickly. And moving all the way to the right on that chart, you can see that the change in employment for every month has started to slow. It's less than about 200,000 right now, but still, those are strong numbers. In the middle, you're looking at the unemployment rate, which spiked during COVID, and it has come down. It's inching back up, but it's still less than 4%, which is still a very tight labor market. But moving to the right here, now we're starting to see some signs of easing. The average hourly earnings change from a year ago. Of course, it spiked during the recession, then came down when we were having to work from home. You could see the blue non-supervisory employees' wages from a year ago increased to around 7% about a year or so ago, and it has come back down to where we're about 4%. It was the lower wage workers that were harder to find, that could not work from home, that received the larger wage increases. But again, all employees did see wage increases, and given that the labor market is cooling, we're starting to see those wage increases coming back down to around 4%, but still that's fairly high for an economy that's cooling off. When we look at job ads now within our Jobs EQ software, we spider over 45,000 sites on a daily basis. We deduplicate it, and we then provide information for our clients to look at. Here on this slide, you're just seeing the total job ads in the U.S. in gray. That's the number from a year ago. And in blue, the current job ads. And we're going all the way back to December 5 of 2022. Actually December 6th of 2021 with the gray lines. We are 18% lower than we were a year ago. So this is a predictor of employment. Clearly, you don't put out an ad for a job if you don't expect your demand to stay strong. So once again, this gives us an idea that the job market is slowing based on job ads. Another sign that the job market is easing is the quit rate. Now, this comes from a survey that the BLS does. They started doing the survey in 2000, so we only have it for about 23 years. But here you can see the quit rate over time, and the gray shaded areas are recessions. The quit rate falls during recessions because people don't want to quit their job during a recession when times are uncertain, because if they don't like the job that they've just taken, if it doesn't work out, then it's going to be harder to find a job. So again, quit rates decline during times of uncertainty. Here you can see after COVID, we had a very high quit rate as people were looking for other jobs. We called it the Great Resignation. But now we've seen the quit rate down to the same levels that we saw pre-COVID. So again, a sign that workers are starting to be a little bit apprehensive about the economy and where it's headed. Initial unemployment claims are also a leading indicator of employment growth. They jump up during recessions, and they've been staying fairly low. So how is that consistent with the slowing economy? We may have something odd going on here, and that is some of the large companies that laid people off have provided good severance packages, and you can't apply for unemployment insurance until after your severance ends. But we have this other phenomenon that anecdotally we've heard a lot about, and that is our employers hoarding workers. They had such a hard time finding workers during COVID and soon after COVID that they're afraid to let these workers go right now for fear that when as the economy continues to grow, they won't find the workers needed. So this to me is the crux of when we'll end up in a recession. That is, in a recession, we see employment decline. It hasn't yet, but it may be in part because of this hoarding of workers. When will we get to the point where employers are seeing the demand for their supplies or goods dropping off enough that they're going to start letting these workers go? So we're watching employment, we're watching initial claims, job postings, all very closely to help us determine when the next recession will be here. So will the Fed maneuver this big plane, this big economy into a soft landing? Or are they coming to the soft landing when, in fact, there's just a cliff ahead? We're of the belief that there's a cliff ahead, and so we still expect to see a recession. Why do we expect a recession? Well, the Federal Reserve has been increasing the federal funds rate. That's the only rate that they could directly affect. It's the rate that banks use to loan to each other on a daily basis, but then it impacts rates going up the curve or out the maturity. It takes 1 year or longer for those increases to impact the economy, because think about it, whether you're buying a home or an automobile, or if you're a business making capital expenditures, oftentimes they're done quite a bit ahead of time. You have a contract that's in place, and you can't break that contract, or you don't change it for some time. But over time, houses, autos, capital expenditures are becoming marginally more expensive, and so demand is dropping. Also, we have an inverted yield curve, meaning interest rates at the low end, such as the 3-month maturity, is higher than those at the long end, such as the 10-year. Historically, when this happens, when the yield curve inverts, we see a recession about a year later. And the curve inverted more than a year ago. Commercial real estate continues to suffer because of all the remote work, but with interest rates higher, it's going to suffer even further, and Francesco will point that out a little more in his presentation. And then consumers make up about 60% of the economy, and they are starting to show signs of weakness. We see that because credit card usage is increasing, delinquencies are increasing, student loan debt has started to be repaid in October, and because of that, there are some students who did not have to pay the $200 to $300 back in their student loans on a monthly basis over the COVID period that are now having to take another $200 or $300 out of their budget. And that's money that they could have spent on or won't be able to spend on other things. And then finally, the federal stimulus to households from the pandemic has ended. And that had a big impact on the economy over quite a period of time. And we see that in the personal income data or the consumer savings data that comes from the Bureau of Economic Analysis. And here we're looking at an analysis from the Federal Reserve Bank in San Francisco. And just recently, about a month or so ago, the savings data were revised, and the dotted line shows you what the excess of savings look like prior to the revision that came out just a couple of months ago. And if you look at that dotted line on the right-hand side, what it showed was that in the second quarter of 2023, all that excess savings from all the federal money was to run out. And that's why many economists thought we'd end up in a recession in the third or fourth quarter of this year. Well, the dark line shows you post revisions what actually the excessive savings rates were. At this point in time, it looks like consumers won't run out of that excess savings until we get to 2024. So this, because the consumers make up 60% of the economy, is very important in terms of what we expect to be slower growth next year. And in fact, we do look for a mild recession. You could see in red our forecast where we have in the first and second quarter of next year a very mild recession. So overall, the economy is showing signs of slowing. We're seeing signs of weakness in the labor market, and that points to changes or expected changes in remote work. So before I hand this over to Francesco, where were we at the beginning of this year? And if you were in some of our webinars, you saw this slide, a Wall Street Journal article in March. The first box there showing you a BLS survey, establishments saying employees teleworked rarely or not at all were 77% pre-COVID. It fell to 60% in 2021 and then increased back to 72% in 2022. In the middle, National Bureau of Economic Research, an NBER survey, employees working fully on site, it was 54% in November of 2021, and it inched up just a little bit to 60.8% in February of 2023. And then the right-hand side box, a survey by Robert Half, 92% of managers prefer their team to work on site. They feel like it's important for innovation, creativity, and collaboration. And also, it's important to maintain a culture in terms of mentoring and training new and existing employees. So that's where we were at the beginning of last year. And then another survey around the same time came out by the American Friendship Project, surveyed over 3,000 adults, who said that 50% said that they lost touch with a friend in 21-22, 44% said they missed out on making friends due to the pandemic, and 34% were unsatisfied with the amount of time typically spent with friends. So the point of this survey or the article was that technology is no substitute for meeting in person. And then finally, and something that Francesco will touch on a little more, is early this year, another article by the Wall Street Journal that the exodus from the big cities was slowing down. And on the left-hand side, you can see a bar chart showing you which cities were seeing an increase and a decrease in population. Overall, the core counties of the large MSAs lost a net 800,000 population in the year ending June 30th, 2022. Suburbs received the most growth, the suburbs of the MSAs, and the rural areas and small towns were relatively flat in terms of population. So with that, I'm going to hand this over to Francesco to talk to you about what the latest trends show.
Thank you, Chris. I hope you can all hear me okay. So first of all, let me get started by some definitions so that we are on the same page about what we mean or what I mean by remote work. There is a little bit of a confusion about all these policies that go under the big umbrella of working from home, which became a big thing during the COVID recession. Under the big umbrella of working from home, we can identify two major policies. The one that is commonly called remote work, which typically require to work 100% of your time away from the workplace. And then there are the so-called hybrid policies, where you combine some time where you actually work in the from home together with some time that you work actually in the workplace. Both policies are really welcomed by workers because they see as a good way to come up in a better work-life balance. And so workers are really demanding this kind of policies, while, as Kristen said, employers are not always keen to go toward remote work. What we saw is that because of the COVID recession and all the restrictions that were posed on social interactions during the lockdown, the percentage of the workforce that had to work from home increased dramatically, and that was reflected on the new job advertisement that we were able to track on our software on JobsEQ, where we see a spike in the second quarter of 2020 of ads that require specifically this option of working remotely. Now, why is it important to differentiate between remote work versus hybrid work? Because the policy implications are different. Typically, remote work allows a worker to move from probably being very close to the workplace because they have to commute daily to the workplace to maybe move to the suburbs. So you still remain in the same area, but maybe you move outside to the suburbs, closer to amenities that may be important to you. Maybe you need more space in the house. Maybe you need less congestion in the traffic, and so on and so forth. When we go into the remote work option, then you're not bounded anymore to be in the same region because you don't have to go to work at all. So then you can even move to another state. And so from an economic development point of view, the impact of losing your population that is moving from downtown to the suburbs may be completely different from the policy implication of your population actually moving out of state. Or from a different point of view is like, how can you as an economic developer attract people, attract workers from other states to relocate in your own state? And that's why I'm trying to emphasize that it is important to know, to differentiate of what is happening to remote work and what is happening to hybrid because of these different implications for economic development. So what we saw is that if we look at purely remote work, which in my language refers to working 100% of the time from home, then you have that we have this trend, this very clear trend that was on the rise. There were more and more ads in our RTI, on our real-time intelligence tracking system, where the percentage of ads that had a reference to remote work was increasing from less than 2% before the pandemic to almost 7% in the second quarter of 2022. Then things start to turn around. We see a slow decline. We don't think that we're going to ever go back to pre-pandemic, but definitely we think that the amount of remote work has peaked and is definitely coming down. Why is that coming down? Because of what Chris mentioned earlier, the fact that employers see a value of having face-to-face interactions with their workers, and we think that even workers see a value of having face-to-face interactions with their co-workers. And so the big experiment is not going to go away, but is definitely going to definitely moderate compared to what we saw during 2022 and to some extent the beginning of 2023. When we look at more the details about the behavior of remote work, we see that most of the decline that we saw in the previous chart is actually driven by a very specific industry and the occupations, and mostly is computer and mathematical occupations where we see this big drop in the number of ads that have a reference to remote work. There are, of course, some occupations that by nature will never have a reference to remote work because they cannot by nature be performed from home. So we see that production occupations of healthcare support occupations, they had a percentage of ads that had a reference to remote work, which has always been very close to zero. Again, nobody's surprised there. But some occupation, we did see a spike in the second quarter of 2020 when the COVID hit the economy. But it's been pretty stable, around 5% for sales, and then around 10% for legal occupation and business and financial operation occupation. The trend there is not very clear. It could be that is slowly declining, but most of the downward trend is actually driven by this specific occupation, which is computer and mathematical related occupations. And you should not be surprised because those are by nature the one that they're more likely to be able to be performed from home because all you need a computer. And if you look down at a more detailed picture of which occupations have the most remote work, we are going to have, well, the one thing that is striking is that there's a variety of the skill set that is needed. You have that some occupations require very little education, such as telemarketer or medical appliance technicians. And then you have occupations that require a more advanced level of education. And those are mostly computer-related occupations, as the previous graph has identified. So we have computer system analysts, we have computer engineering, software developers. Those are all occupations that can be easily, you only need an internet connection and a laptop or a desktop, and you can perform your work from home. They also require very little interaction with your coworkers. But some of these occupations have a very large percentage of the ads that actually have a reference to remote work. And that's the one thing that we're going to notice. The problem of remote work is that it's not distributed equally among all occupations. There are some occupations that by nature have this quote unquote advantage of being able to be performed from home, while other occupations don't have that option. They don't have that possibility. So it's very concentrated among specific occupation, proofreaders and copy markers. Almost 50% of all the jobs that we track on JobsEQ have a reference to remote work. Of course, if you're a production worker, you have to go to the plant and you cannot definitely work from home. So it's not, quote unquote, a fair policy. It is clearly giving this increasing the value of work-life balance, but not for all workers. It's only for workers in specific occupations. We look at the geography of remote work, and as a reminder, in my language, remote work is a work that can be performed 100% from home. We see that there was an increase in the metropolitan statistical areas, but then a drop in the last in the third quarter of 2023. I say the last quarter because we haven't finished with the fourth quarter of 2023, but that trend is definitely continuing. If you look at the monthly data, that trend, the downward trend, is definitely still visible even in the most recent months. And we see literally a drop of in the amount of remote work in big cities. Look at Chicago, look at San Francisco, that we're almost more than 9% of the job ads in the third quarter of 2022, so a year ago, had a reference to remote work, and now not even 6% have a reference of they report in the ad the option to work remotely. So definitely the big cities are the ones they are driving down this decline in the popularity of remote work. There are some exceptions. There are some locations where actually remote work is up, but it's really an exception. There's only really a handful of cities where that is actually happening. And those tend to be, interestingly enough, smaller cities. And also interesting because they're smaller cities not too far from a big city. So like Syracuse, right? Or Albany, New York. Those are people that probably employers are trying to compete with talent of people that are in New York City. So in order to do that, they have to be more flexible because they don't have the competitive advantage of being located in New York City. So probably employers in Albany, they feel like they have to offer this benefit in order to stay competitive. But again, I picked 4 cities for you, but those are really the exception where we see an increase in the incidence of remote work across the board. Smaller, larger, and medium-sized cities are all experiencing a decline in the in employers that are offering this option of working remotely for their new positions. So what is the the situation now and what is likely to happen in 2024. There was recently a survey, this is in November, there was a survey published by Resume Builder of about 1,000 CEOs, CFOs, and HR, all the big guys of companies that had at least 11 employees. And currently of this sample, it's not representative of the United States, but it is a pretty large sample of United States employers. And currently 51% of all the employers have already implemented the return to the office policy. And there's another 40% that is expecting to return to the office, to implement a return to office policy by the end of next year. So by the end of 2024, we expect almost 90% of all the business to go back to the office, which is, a pretty dramatic shift from what was the experience in the last 3 years. But what is going to be the new normal? Once we see that this working from home policy is going to fade out, what is likely to look, are we going back to 2019? Is the way America goes back to work the same as how America used to go to work in 2019? Well, the answer is not, because what is going to change, although workers are coming back to the office, when workers are coming back to the office is going to change. So the yellow bars represent currently how many people will come to work 5 days a week, 4 days a week, all the way to once a week. And what we expect that in 2024, that's going to change. And the majority of companies, although they're going to require their workers to return to the office, they're not going to expect them to be in the office 5 days a week. And most likely what we're going to see is people, they're going to come to the office between 4 and 3 times a day. Of course, by nature, if you're a restaurant, you need to have your employees coming to the office every day, because otherwise, the production function of your company requires workers to be on site every day. So some establishment will have their employees coming to the office 5 days a week, but overall, the majority of the establishment will expect workers to, yes, come back to the office, but between 3 and 4 days a week. So what I did is I made use of our in-house tool that is called RTI, Real-Time Intelligence. And I wanted to track how many jobs, how many new ads actually refer to the possibility of working hybrid for the position that was advertised. And on the blue line represents the number of jobs that have that reference to hybrid in the last 12 months compared to the gray line, which is the reference in the previous year. So clearly we see that although the number of remote jobs is declining, we see a very strong, robust demand for workers to work hybrid. And why is that the case? Because I think that employers recognize the need that workers have of having a better work-life balance, but at the same time, they really value the interaction that takes place on the workplace, on the site. And hybrid seems to be the best combination, the best compromise between the two needs that we all understand are valid points, right? So the demand for hybrid is definitely increasing, at least compared to a year ago. And which one are the occupations where we see the largest number of jobs which have in the advertisement have reference to hybrid? The 10 occupations that are listed in the slide in front of you, they capture almost a third of all the job listings that have a reference for a hybrid. So this is the bulk of all the hybrid positions. I'm assuming we're not surprised to see some of the titles there. We have computer information system managers, we have software developers, we have computer user support specialists. Some of these occupations are the same one that a year ago were advertised as remote, and now they're changing from remote to hybrid. Okay, so there is a shift of the modality that employers are expecting employees to perform their job from being 100% at home now to being hybrid. What we also notice that, interestingly enough, is that if a position is advertised as a hybrid position, has a smaller duration as being active on our tracking system, on our RTI, meaning that an HR person can fill that position much faster, on average 4 days faster, but it is 4 days faster than if the position is not associated with a hybrid work schedule. For example, computer and information system managers, typically on average, a position stays open 35 days if the position is hybrid, but it stays open for 40 days if the position does not refer to the option of a hybrid work schedule. Another thing that I thought was interesting, because personally I did not expect that, is that wages, generally speaking, wages for occupations that are associated with a hybrid work schedule are typically higher than wages that are associated with jobs that are expected to be performed 100% of the time on site. I was surprised personally, because I expected that people would pay a premium for this flexibility, or would pay a penalty, I should say, not a premium, for this increased flexibility. And on the other side, we see the opposite. We see that positions that are associated with hybrid work schedule actually pay higher wages. And raises the question why that may be. Well, it could be that larger firms, which typically pay higher wages, they are more keen, they're more able, because of the resources, to allow more hybrid work. So that's the reason why you may see that, for example, an architectural and engineering manager on average makes $98,000 if the position is hybrid, but only $92,000 if the position is face-to-face. But it could be that people with better skills, they have more bargaining power, and they say, because they have better skills, they can demand higher wages. But then at the same time, not only they can demand higher wages, but they can also tell the employer, if you really want me, you have to give me this possibility of a better work-life balance. So again, it's not true across all the occupations, but for the majority of the occupations, the differences are pretty sizable, around $7,000 more if the position is advertised as hybrid compared to a position that is only does not have any reference. And the default is that if you don't refer to specifically to a hybrid work schedule, then you're expected to go to work on site every day. And this is another interesting slide. I was able to track the original number of jobs that had a reference to remote work, which is, remember the slide, the bar slide that at the beginning of my portion of the presentation, now has a new shape, is the gray shape, but it's the same information. That's the one slide that shows an increase in the amount of remote jobs all the way up to the second quarter of 2022, and then a decline after the second quarter of 2022. But I now map that trend against the trend of the percentage of job ads that have a reference to a hybrid work schedule. And then what we see instead is a pretty consistent increase, except for probably the last quarter, where there was a teeny tiny decline in the hybrid positions. But overall, what we see is that hybrid jobs are overtaking remote jobs. So that's the big change of 2024 that, I'm not saying that remote jobs are going to disappear, but definitely they're going to decline, they're going to moderate, they're going to become less prevalent. And what we see instead on the rise is being the hybrid jobs that they're going to take over. And what jobs are most likely to be advertised as having the option of a hybrid work schedule? Well, So again, some of the jobs are overlapping with the jobs that earlier we saw were popular among remote work positions. But then we see some new people, some new categories: art directors, lawyers. Let's see, if you, I don't have the entire list, but you have HR manager. So positions is becoming spread across a wider variety of occupations. It's not concentrated as hybrid references are not concentrated among only few occupations as it was for remote work, but is actually opening the door to more occupations where you see giving access to more categories, to more workers, the opportunity of having a better work-life balance. So you don't have that most of the gains are like 48%, as you remember, were into copy writers and copywriter, I forgot the name. So less concentrated, but available among a larger base of workers. So that should be, good news, because it's giving options to a larger base of workers to come up with a better balance of work-life balance. Another thing that is interesting about hybrid, and you can draw, I'm not going to draw the conclusion, but I'm going to let you draw the conclusion, is that we noticed that capital cities tend to be the cities where you have the largest percentage of jobs that have a reference to hybrid work schedule. And of course, the obvious implication of this one is that government jobs tend to be more friendly toward a hybrid work schedule. But clearly you have Olympia there, Lansing, you have Hartford, Trenton, Washington, D.C., Cheyenne, and all the other cities, Aurora for Colorado, Denver for Colorado, and so on and so forth. So seems to be government positions tend to be more hybrid friendly. And finally, I would love to talk about, okay, what is the future of the work week for 2024 and beyond, for if you want to be honest. And so I want to use some results of an interesting study conducted by Castle System. Castle System is a maker of key cards, fobs, or even just an app that you can have on your cell phone that gives workers access to buildings. So they have all this information about people coming in and out of buildings, and they guarantee security for the buildings. They manage almost 2,600 buildings for about 41,000 businesses across 47 states. So they have a lot of information about everybody that is working in and working out of an office space. And they can monitor that footprint. Okay, they can know day by day how many people are walking to a building, how many people are walking outside the building. And this is what they found. Well, they found that as last 2 weeks ago, this is December 6th, so about 2 weeks ago, the average weekly occupancy rate in the 10 largest cities in the United States, which are listed on the slide in front of you, San Francisco, Austin, Chicago, Washington, San Jose, New York, Houston, Los Angeles, Dallas, and Philadelphia. The occupancy rate is, the average occupancy rate is about 52%. Okay, it doesn't mean that there is 48% of the office space that is empty. It means that on average, the buildings are used on average 52% of their full potential office space. It means that some people come only 1 day, 2 days, so 52% of the time of the week time, the building is not used. The city that seems to have the largest, the highest occupancy rate is Austin, and still is only 65%. And the city that is still is really still lagging behind in terms of occupancy rate is Philadelphia, with an average occupancy rate of 43%. What is the implication of low occupancy rate? Well, first of all, if that is becoming the new norm, then employers don't need all the space that we currently have, right? If only 51% of the space is used on average in a week, we don't need all that space. So probably what in the future workers they will do is that they will redesign the office space so that there's more shared workplaces, so that people can share the office, since they're not going to be the same day in the office. So there's going to be some redesigning from an architectural point of view, but that's also going to decrease the demand for square footage, because clearly now the buildings are way too big for what we need. And so we expect that to have an important impact for the value of commercial real estate, which I will briefly touch in a second. Before some other interesting facts, I'm assuming everybody here will not be surprised to hear that the day of the week with the lowest occupancy rate is Friday. And like in New York City, it's about 25% of the office space in New York City is occupied on Friday, 25%. That's pretty low. The day of the week with the highest occupancy rate is instead Tuesday. Used to be Wednesday. Over the summer was Wednesday, but now it's shifting to Tuesday. And most likely because you're going to see some businesses that are requiring Tuesday and Thursday, some businesses they're going to require Tuesday and Wednesday, or Tuesday, Wednesday, and Thursday, but Tuesday seems to be the common denominator of the most common return to the office policy. So Tuesday is the day of the week where where you're going to see the highest occupancy rate. And this is the trend since the pandemic. By the 10, again, for the 10 biggest cities. So we see that huge plunge from 100% to about 10% for the big 10 cities, with a steady increase. But then what we observe is that from the beginning of the year, from January 2023, we have kind of sold, we have reached a plateau in the amount of the occupancy rate. It doesn't look like it's going to get any better than what we have done right now. And this raises a lot of important questions for economic development, because now we're moving from a downtown that used to support workers 5 days a week, at least for lunchtime, to a new landscape where workers are coming to downtown only 3 days a week. Best case scenario, maybe sometimes twice a week. And so there's all of this network of infrastructure that would sustain that type of economy, such as coffee shops and restaurants and even parking lots, right? They would take into account of a specific demand for their services, and now it looks like that demand is not going to come back. It's not that it's not going to come back soon. It's not going to come back, period. So that raises the question, how do we make sure that these restaurants can actually survive? How do we attract people back to downtown? What is going to be the future of downtown? What we can, as economic developer, think about creative way to make sure that downtown, remains the downtown, the active life that downtown used to have. So some of the options on the table is to convert some of the existing office spaces in living spaces, which raises another big can of worms. I'm not going to go there because it's not the topic of the presentation, but that is one of the options. A lot of interesting problems that are going to be, to me, very important problems for 2024 and the future is, what is the future of downtown? And finally, I would love to, probably not the best slide to conclude my presentation on the gloomy side, but because of this decline in demand for office space, the commercial value of office buildings has plummeted. And when I say plummeted, I mean 35% below where it was at the peak in 2022. This could potentially be a problem in 2024. And why is that the case? There is almost $1.5 trillion of commercial real estate debt that is due for repayment by the end of 2025. And when the developer will go to the bank to repay the debt and possibly ask for a new loan, an extension of the new one, two things are going to happen. Well, one, because the value of your building is 35% lower than it was in 2022 when you first got the loan, you're not going to get the same amount of money that you got before. If you combine that one with the fact that interest rates right now are, at 7%, while 3 years ago they were in the 3-4%, so they have doubled. You're going to put an extra strain on the financial resources of the developers, and so that's going to put a lot of businesses in the situation where they would have to sell their building because financially it's not feasible for them to sustain the drop in the value combined with the higher interest rate. But now they have to sell it at a discount price, and so that's going to have potentially some serious domino effect on the economy, as if there is a delinquency rate on mortgage payments and so on and so forth, that may spread in other area of the economy. So I'm sorry to end the presentation, the Christmas presentation with some bad news, but it's definitely something that we're going to keep an eye on, making sure that we track what is going on in the commercial real estate debt, and if that's going to develop into a crisis for the United States in 2024. And that's the end of my conversation.
Francesco, thanks for that great information. Very informative. I'll go ahead and answer a couple of questions that I saw out there while you catch your breath here, and then we'll turn it over, I guess, to Andrew to pick some questions. But one, Phyllis Allison, I saw your thought, and I agree with you. I was wondering too on the hybrid, paying more than the people who have to go to the office, and I went to right away that they were probably more experienced and allowed to work from home. But sort of a plug for Jobs EQ here, we are soon going to have experience as one of the indicators that you can look at in terms of the job postings. So we can test that theory when we get that data into the job postings. And then also, Malav asked a good question, much more detailed than can be answered here, but about our recession model. It's a model that's run with over 100 different equations that all kind of feed off of each other on the theoretical underpinnings of macroeconomics, for those of you who have had economics. And, so you've got GDP equals consumption plus investments plus government spending and net exports. And so that's basically how we and most economists have their model. Now, ours is only 100 equations or so. The Fed, I think, probably has one with, a couple thousand equations, but similar in terms of the thought process of how it's built. And then I also saw the question about remote work. Is it more often, is there a seasonality to it? That is, in the when it's cold and snowing, does remote work ads go up? And so I did run to Jobs EQ during the presentation and look at Massachusetts, and I could not see any seasonality in the winter, but we'll delve into that further. And I did see Andrew put a comment out there about fires. If there are mountain fires or fires, is there a similarity? So I can see a blog in the making with the title of something like "Fires and Snow: Its Impact on Remote Work." So, Andrew, I'll pass it back to you to see if you had any other interesting questions you wanted us to try to answer in this last 5 minutes.
Yeah, Chris, you're a step ahead of me there with the blog ideas, as well as we had one about educators as well come in, which reminds me of some of the work Greg's doing. But let's go back to hybrid themes. And there was good conversation in the chat around the increased pay for hybrid workers over those in office. And somebody mentioned that it could be because they were more experienced. Is there any correlation between experience level, seniority, and hybrid opportunities being offered to those versus entry-level employees?
Definitely experience plays a big role on your wage settings. And definitely that could be a reason why wages are higher for positions associated with a hybrid work schedule. And as Kristen said, as soon as that new feature of Job CQ will become active, that would be an interesting topic to have a blog about.
I know this is a great content mining source for us. We'll try and get to one or two more. We had one again on the theme of hybrid around definitions. Question came in, we're required to go into office 3 days a year. Is that considered hybrid in Jobs EQ?
No, Jobs EQ does not define hybrid or remote. It's left to whoever writes the ad. So whatever is in the mind of the HR person that wrote the ad, we have no control on that one. If they in the ad the word is remote, or in the ad the word is hybrid, we don't have a way of identifying what they actually mean by that.
Okay, great.
So
and then,
generally speaking, the understanding in the field is that remote should be 100%. You know, 3 days a month, 3 days a year, I would call that a remote. You know, because you're not, usually hybrid is when weekly you're expected to go at least once. Then, you know, that is considered hybrid. And again, why? Because if it is, the idea is the behavior is like, if you are expected to go only 3 times a year, you can still live in another state, and that for the 3 times you fly, you know, to the headquarters.
Certainly. Yeah, so with that, all right, so it sounds like it sounds like RTI Jobs EQ is pulling actual keywords, remote, hybrid.
Yes.
Are there any other keywords that you could recommend to search for remote or hybrid positions? The one that comes to mind for me would be off-site. I wasn't sure if there were any others that our users should be looking at in order to find those opportunities or define those opportunities, if you will.
Chris, do you have any opinion?
Yeah, Francesco, that's a good question. I think that would be a question for data governance, but I would think that they have taken into account offsite and any other words that might have the implication of being remote and included them in the definition. So I would expect that that's included, but we could check with data governance and get an answer.
The only problem of offsite is that if you are, you know, if by nature you travel because of your job, so you say offsite, but that's not remote because you can work from home. Is because by nature your job is, you know, if you're like a, for example, a rep for a pharmaceutical company and your job is to be offsite, I would not call that remote. That, but it's, you know, it's an interesting, you know, point to consider.
Yeah, for sure.
Whether offsite is remote or not.
Okay, I think that's all we have time for this afternoon. Again, to those of you who participated, we'll follow up with a link to the recording of this webinar. You'll receive the slides there as well. And again, you can always visit chmura.com. And under our resources tabs, we have a catalog of all our previous webinars that you can access and rewatch at your leisure. Dr. Chmura, Dr. Francesco, excuse me, Dr. Renna, very much appreciate your time this afternoon. Thank you both, and thank you to all who joined us today.